program organized by the Committee on Capital Markets and Investor Protection of the ICAI. Through the course of these 3 days, members and their clients will hopefully benefit from understanding about new avenues for investments. To start with, we have CA Vinit from Pune, who will be giving us an introduction to investing in startups. Before we move on to the session, I'd like to call upon our chairman, CA Ranjitha Varya, to welcome our speaker as well as the participants.
Thank you, Alan. Very good afternoon to all of you. Very respected speaker, faculty member, eminent faculty member for this fine evening, Vinit Deo sir from Pune. My very respected managing committee colleagues, participants probably from across the country, non-CAs and CAs. Once again, a very good evening to all of you, and welcome to this 3-day investor awareness program organized by the Central Committee and hosted by the Ernakulam branch. As Alan rightly said, Vinit Deo sir would start today with guiding us or rather giving us more awareness on how we can approach for investments towards these startup corporates. I'm sure it is in fact a cloud for many that we are quite unaware among the public as well as the professionals, where how do we approach investing in a startup idea or a concept or a corporate, that many of us know that especially during these COVID times, that a lot of these startup corporates, especially related to technology and medical field, have grown overnight for their various innovative concepts and ideas. So how do we rather approach them? How do we invest in them? How do we be part of this growth is a big question mark for many of us, I would say. So indeed, a very apt topic. I would believe that Vinit Deo sir from Pune is a very apt personality or a very eminent faculty that he has been across the country guiding and taking sessions of this nature, especially concerning investment side. So wholeheartedly welcoming Vinit Deo sir on behalf of each and every managing committee member and participants to this.
My pleasure to be here. My pleasure to be here.
Thank you. My very respected managing committee colleagues, Vice Chairman of the branch, CA KV Joseph, Treasurer of the branch, Alan Joseph, Secretary of the branch, CA Deepa Varghese, wholeheartedly welcoming my managing committee colleagues to this webinar. And very respected participants, wholeheartedly welcoming each one of you. Let's have a great evening of learning today. Pretty much over and back to Alan Joseph. Thank you so much.
Thank you, Chairman. It's my privilege to introduce a very accomplished chartered accountant. CA Vinit Deo sir brings over 2 decades of experience in the field of finance and advisory services. He leads the Possiview consulting team based out of Pune. He has led the closure of over 100 funding and over 200 advisory transactions from with a value from a very few crores to a few hundred crores. He has a corporate experience with Times of India Group as well as the Geometric Software Solutions. He's a regular contributor of articles to media firms such as Times of India, Money Control, and Sakar. And he also addresses sessions on topics of fundraising, RERA, business opportunities, etc. He was selected as a professional icon of Pune by Lokmat in 2016. He's active in the field of, he's an active professional, and he's also a managing committee member and vice chairman of the Pune chapter of the Institute of Chartered Accountants. And he was also the convener of the WIRC COVID-19 Economic Response Task Force. With these short words of introduction, may I now request Vinit Deo sir to kindly commence the session.
Right. So, thank you so much, President Ranjit. He was proactive to reach out, and it's incidentally, Ernakulam, Kochi is, I mean, one of my favorite cities, been there a couple of times. The states, as you know, as is called God's own country. So I think it's the pleasure I can feel even from right here. And we've traveled at multiple places there, of course, as a tourist destination. So would love to, once this whole thing of COVID is gone, would love to even come there and interact. I guess you also have a very healthy startup scene with, I think there's this Kochi, I forgot the name, but there's a startup mission out there, and which is very active. During the course of the session, I just tried to find out and let you know. I just forgot the name. But anyway, Ranjit, Alan, Mr. Jose, thank you so much for the kind introduction. And it's a pleasure and privilege to address all of you. I'll just try to share my screen. There's a couple of presentations I have, but during the course, I think the focus of all of this, I want to keep as very, very practical, practice-oriented, because it's a new age. It's not really new. It's been around for a decade or so, but last 3-4 years, it's really, really picked up. But as a professional or a small and medium practitioner, it becomes difficult to, catch the thread as to where should I start from and really get professional opportunities from this. So the idea is to explore those options. So keep your questions coming. If there's a coordinator who's going to shoot off questions to me, that's fine. If you want to raise your hand and ask a question right there and there on the slide, there'll be no interruption. I can just take it after I'm done speaking. So I think let's try to replicate a physical CP program model as much as possible, because over the year and a half, most of us have got used to these WebEx and Zoom meetings. So let's try to make ourselves comfortable and be close to each other as much as possible. There I go. Okay, great. Sure. So there are going to be two presentations. One is this, and there's one more which we'll take up after this. And it's a short 7-8 slide presentation, but I'll end up giving my insights of working in this segment for the last decade and a half. So number one, a very basic thing that we need to explore is, or look at, is what is a startup? Okay, and there are all kinds of fancy stuff which goes around as to what a startup is. So number one, at a very base level, all of us who studied chartered accounts anyways know that any new enterprise is technically a startup, right? So a client comes to you and wants to start, for example, a retail shop. That's a startup. Why? Because he started up a new entity. Okay, it might be a proprietorship firm. It can be anything. Somebody wants to start a manufacturing outfit. Somebody wants to start a travel agency. All of these, in the general course of the term, are anyway startups. But that's not what we are here to discuss today. In the sense, we are going to narrow down the definition of a startup. And then, for the purpose of this session, for the purpose of how startups are understood in the technical parlance today. So as you all again know, as such, there is no, as far as Companies Act is concerned and so on, there's no definition of startup. Although the ministry, now there's a, for purpose of benefits, there is a definition of startup, which we'll get to in a slide or two. But effectively, what we've come to understand as startup are, number one, an entity which creates innovative products or solutions. Okay. As I said just a few minutes earlier, technically anything new which starts is a startup. Okay, it can be old business, traditional business as well. But when we are going to look at startups today, this is what we are looking at. Okay, innovative products and solutions. Now, again in this, there's something very interesting that you need to understand. Many of these startups, are they really, patented products, fancy kind of stuff, very high on R&D and so on and so forth? Maybe not. So let's look at Ola as a startup. Uber was already there, right? So technically, is it an innovative idea? No, you're just kind of, with due respect to the founder, executing the idea is as difficult. But broadly, Uber had existed, not just Uber, multiple companies like that post Uber had existed. Then Ola came in. Same is true for Flipkart. There was Amazon. Same is true for many of the entities where there were similar entities anyways. So in that sense, would you really call them innovative products or solutions? In a sense, no. Maybe innovative in the sense of India, or maybe not even that. So for example, before Ola came in, there was something, I'm sure there would have been city level taxi services. So there was, for example, I don't know whether it was in Kerala, but in West India, there was a cab service called Meru, for example. Even there, it would have been, Meru cabs and so on and so forth. But of course, they were not there on the app. You had to still call them and so on and so forth. But coming back, when we say creating innovative products or solutions, the point I'm trying to make is that there could be a lot of startups which have copied another idea. Ideas don't have copyrights in themselves, so you can easily look at an idea and if the design is not copyrighted or if the tech is not copyrighted, you can do it and you can do a better stuff out of it. Second is, so start looking at this from the eyes of, imagine you're sitting in your office and somebody comes up and he says, I'm a startup, okay, and I need to grow and I need funding and so on and so forth. What are the angles from which you have to look at that person? These are the angles. Is he really a startup in the sense that we understand today? So these are the key ideas. Then is the person saying that, look, there might be somebody who's got an innovative idea, but he says, I want to do this idea. For example, I want to do a taxi service which is based on app and maybe some different kind of app. Maybe it comes faster, or maybe it is premium, some innovation. But it will be there, for example, only in Kochi or a few other cities and so on and so forth. So in today's world, we don't really call it a startup. A startup is someone whose promoter aspires for it to become, if not an international player, at least a large national player, a market leader, one of the top 3 players, and so on and so forth. So that's a startup. Okay. Third is then the promoter should continuously aim at growth. Growth not in terms of 5, 10, 20% growth like we look for bank proposals and so on and so forth. Multiplier growth. Like today's startups who get funding are growing at like 10, 15, 20% month on month. Some are doubling every month and so on and so forth. That is because the idea just clicks. So you can imagine 10 years back, if you have to take a review, many of the companies which are now unicorns were just about starting or may not have been there 10 years back. A Paytm or Zomato, Swiggy, Dunzo, all this Ola. So all of these people are now valued at multiple $1 billion. So valuation is one metric. Revenue-wise, there would be several $100 million, right? So where did that, a company which is zero maybe in 2010 is now doing a business of 1,000 crore, 2,000 crores in 10 years. So they would have, not just grown twice, they would have grown like 3 times, 4 times, 10 times in, maybe in the initial stage, because the idea clicked, people wanted it. So people wanted a taxi service, for example, or people wanted, that trend started, they wanted food at home and so on and so forth. So these are the guys, as a promoter, when you speak to somebody who's like hungry for growth. Sorry. Last, very, very, very important. Am I audible? Hello?
Yes.
I just keep, yeah. So, yeah. Yeah. So I was saying last bit is focused on increasing value for shareholders. Now, you might know many promoters who would be growing their business, revenue growth, and so on and so forth. But what a startup promoter needs to do is he also needs to understand the shareholder value. So they keep on either raising capital. The idea is to be at some stage do a public issue and so on and so forth. So even that will have to be looked at. Now we'll talk more about increasing this value for shareholders later. So there you have to also, for example, recruit some middle level people. It should not be a single person proprietor. I mean, it might be structured as a private limited company, but it shouldn't be run as such. There has to be secondary management, so that in case something happens to the promoter, that's one. On the positive side, there is a group of people who is looking at it and so on. So effectively, in a nutshell, and there could be a few other attributes of startups as well, but typically this is what we are looking at when we talk about startup. Now, technically, the government is saying that for recognition as a startup, and we also looked at some of these income tax benefits and so on and so forth. Then they are saying if up to a period of 10 years, turnover of the entity has not exceeded 100 crore rupees. Entities working towards innovation, development, or improvement of products or processes or services, or can generate employment or wealth creation. And of course, it's not formed by splitting of another entity. So for government benefits, this is the technical definition which follows. Of course, they have also mentioned innovation and so on. What they have done basically is they have set up an interministerial board of certification with representatives from 3 different departments, DIPP, Biotech, and Science and Technology. And then they evaluate these startups. And for technically getting recognized as a startup, you need to be either a private limited company or a LLP. So that's the technical angle. Okay. Before I jump into this, some preamble. See, effectively, why are we looking at this now from a professional perspective? See, startups are getting, who are the guys who are getting lots of funding from these venture capital funds? These are the startups. Now, in the second presentation, I will also look at, what are the kind of things that VC funds are looking at, that so you can tell your or guide your clients accordingly. And they are looking at these attributes that I said in the first slide. Is it satisfying some of these basic criteria? There, of course, we'll look at some more criteria and so on and so forth. But are these basic things being satisfied? So if these are the things that a VC fund or investor is looking at, and a startup is effectively going to come to you apart from regulatory stuff or setting up and so on and so forth, that's a service that you are anyways giving, so you can keep giving that. But for maybe approaching VC funds and so on, then these are the criteria that should be met. And hence we are looking at startups from the perspective that, is this fundable? Is this idea fundable? And some of those characteristics I will tell you, because a client will come to you saying, look, I want to raise VC fund, and maybe the valuation is 10 crore rupees, or it's startup valuation is 5 crore rupees, I want to raise 50 lakh rupees and so on. So they will come to you for such kind of things. And today's session, by the end of it, hopefully all of you will have the necessary tools, necessary knowledge to at least answer the prima facie questions. You will know how to address him, what questions to ask, what to look at. The idea is to pass on that knowledge and empower you from that perspective. So having looked at, what kind of companies typically would be startups, why look at investing in startups? Okay. So because there's a stock market, there are banks, there are mutual funds, there's gold, and so on and so forth. You may have a startup might come to you, or a client who's got surplus funds might come to you saying, look, there's this lot of buzz around startups. If you as a CA know some good companies, I would love to invest. And as a chartered accountant, since you are qualified to analyze companies and so on, why don't you recommend, for example, etc. Or you may approach clients and get them to evaluate certain startups that you may have. This process, this is what we do for a living, for example. We run an investment banking firm where we are connected to 100 plus VC funds, angels, angel networks, and so on and so forth. So day in, day out, we talk either to entrepreneurs or to investors. Now, so we are, so what we're looking at is why invest in startups. There, some key reasons that one can look at are, as I said, you have options starting from a 3-4% bank FD to maybe stock market where there are risks, but potentially maybe 15-16%. Now, of course, with the way the Sensex is going, one doesn't know, you can just run crazy returns. But generally, historically, 15 to 18% returns, good quality companies, etc., you earned. And maybe mutual funds at 7-8% or more, and so on and so forth. But why invest in startups? So point one is startups can have unlimited growth potential. Unlimited could, as I said, companies which started maybe 10 years back or even 5-6 years back with paid up capital of ₹1 lakh are now valued at, not hundreds of crores. They are at thousands of crores or tens of thousands of crores, which is unimaginable. Okay, so many times one gives example that, for example, that you invested in 1990s in Infosys and bought shares for 1,000 rupees, they would be now worth maybe X crore rupees or whatever, X tens of lakhs rupees or so on. Now here, instead of 20, 30 years, there's a potential that in a 5-year period, maybe 100 rupees can become maybe whatever. It could be 1,000, it could be 10,000, it could be whatever. I mean, any kind of number. So that's the this one. Yeah, that's what would happen. Now, because of that, if you got surplus money, apart from these asset classes, you can evaluate startups as a category for a person who's done investing in all of these asset classes, because it's a very risky asset class. Because there are companies, as you see, they can go to any extent. There are companies which can also become zero. Because it's risk. If the product doesn't work and tens of crores have been invested, then the whole idea is it's an innovative idea. It may work, it may not work. So, for example, or it may not totally become zero, but maybe a 1,000 rupee thing can get down to 1,500 rupees. So there was this very fancy startup called, for example, housing.com. They had done advertisement all over, and they were trying to sell online property and so on and so forth. It got sold to another company for, obviously, even the capital would not have been recovered, probably. So those kind of things generally don't make news. The guys who make news are like a Zomato and a Swiggy, and because they keep on growing. But rest assured that for every one success story, there are like 99 failure stories. So on one hand, there is unlimited growth potential. On the other hand, it can all absolutely become zero. This is something that you should know. And if you are working in this space, and because the topic is introduction to investment in startups, like the way mutual funds give a disclaimer, they carry any mutual fund ad you see, there's a disclaimer saying mutual funds are subject to market risk. Of course, they say it so fast that you don't realize what is being said. But the fact is, the first line that you should say is, this money can actually become zero. And the investor has to be educated like that. Because it's not backed by any collateral, it's not backed by guarantee, it's just a share capital of an enterprise. So that's point number one. Secondly, shall we go to the third point first? I am saying this is not from a CA's angle. Why invest in startups is from an investor's angle. And if you're a chartered accountant of an investor, or if you're going to invest and telling him that, why don't you also explore this option? Then he will ask you, why should I? And what is the answer that you can give? Okay. So one is, of course, unlimited growth potential. Then, as I said, business opportunities in the startup ecosystem. So imagine, for example, that there's somebody who takes a 2%, 5%, 10% stake in a company. So imagine that there's a guy who's a garment trader, and he takes some stake in an e-commerce site selling, garments or something related, for example. Now he's connected to the ecosystem. This is what is called as a strategic investment. Okay. So that is helpful to him. He knows the people out and so on and so forth. Or somebody, for example, in Kerala, I can give you a live example, in fact. So there's a startup which is doing some very interesting work in the fisheries space. And they are consulting the entire fisheries ecosystem and so on and so forth, the fish farmer and so on, the complete aquaculture kind of ecosystem, they are getting together. So we had a investor or a client who are one of India's, if they're a large fish exporter, for example. So they were interested, for example, investing because this is a new age startup which is coming up. They get connected to the entire aquaculture system throughout India. So by being there, or maybe if you get a board seat, as I've said just a step earlier, I'll come to that. So as an investor, just by connecting, I can get a lot of information. I can get direct benefits like trading. I can get an edge over my competition and so on and so forth. So if the investor is from a similar field, like there's a doctor who invests in a medical technology startup. Now he can get opportunities and so on. Then, as I said, a step above, playing role of advisor, mentor, director. Now, if you know the space, and if the investor is from the same industry, then he can also, and the startup, for example, likes him and wants his knowledge also. Then, because a startup founder may not be a doctor, a medical technology startup founder may not be a doctor, but if he's got a doctor on the board or a reputed guy in the board, it can be helpful. So the investor can play the role of an advisor or a mentor or a director to the startup. Now that gives you certain degree of prestige. Imagine being on a board of a company which is growing fast. Now that gives you status in society. Imagine being on the board of Infosys 15, 20 years back when it was SME, maybe 100 crore company, and you continue. So that's a very different level that you have. Your whole profession can go to a different level, etc. So when we say invest in startups, that's the third reason that you can appeal to an investor. Then increasing knowledge and understanding of new domain. Now these startups, generally traditional businesses are rooted where they are. I mean, their knowledge of their own industry, of course they know everything or they know many things, but the new learnings, what is happening globally, and so on and so forth is very, very critical. And many times that knowledge can be make or break with the way technology and with the way businesses are moving. So let's say, for example, if you're in the restaurant industry and there's a new app dealing with something which is food technology. Now, imagine last 4 years, 5 years, restaurant industry has changed so much. Zomato earlier would have stood at a restaurant door saying, please, pay me some money and I will list you on my portal. Now, because Zomato is into delivery or Swiggy is into delivery, depending on the ratings on Zomato, ratings on Swiggy, for example, you decide where to order. And indirectly, because Zomato and Swiggy have all of the artificial intelligence and knowledge, they know, for example, that this guy every weekend, for example, orders whatever, maybe likes a pizza, for example. And then they can match it up with lots of algorithms, which they actually do. So they will match up or add on data of cricket matches and football matches and so on and so forth. They'll keep on collecting. They'll look at, your social media profiles and so on. And incidentally, on the day of a match, you'll get a push notification saying, look, offers on pizza. Now, they have come to that level. It's not just banner ads anymore. It's all based on AI, machine learning, and so on and so forth. And then you'll say, wow, and the chance of you then ordering a pizza on a match day is like much higher. So it is Zomato, Swiggy, and people like them who will actually control the restaurants, not the other way around. And then they can also say that, look, do you want to order from a prominent restaurant a pizza of $300? Or, for example, something worth $100, which is coming from a dark kitchen, which is a new concept coming up. So these concepts of a dark kitchen, if a restaurant owner knows, now that's also an old concept now, but when they would have started, just kitchens without restaurants. So after restaurant, they were like takeaways. After takeaways, the next concept is just a kitchen where this app will order. I mean, you'll order from an app and you just get delivered to you. Now, newer and newer such ideas and concepts will keep coming up. And if you are from the same industry, so if your client is from investor is from the industry, then he can get more knowledge and do his business better. Maybe it can get saved because he's now understanding cutting edge what is going on. Right? Okay. Then of course is applying your. So I'm saying the reason I've said your is you. Okay, or your client's knowledge of his sector is because you will end up also playing integral role. The client will say, okay, after investing, be with me. Okay, so you have your financial, so you can work on certain items. We'll come to that later. But basically, that knowledge can be applied to the industry. Yeah, as I said. And I will share these presentations with the president anyway, so you can share. So this will become like a guideline anyways for you. And feel free to question, because to pose questions, we keep on. This has come out of a decade of practical expertise and practical experience, and from Q&A, etc. So we'll keep on updating this with your questions anyways. But as I said earlier, risks of startup investing, apart from the last point that is said, risk of partial or total loss of investment. It may not be total loss, but it is possible that you invested, assuming that a company will grow 100x, but it just grew normally, just grew 2x, 3x, and or a new company came in, it was better funded, and just zoomed past, and then yours couldn't tick. So again, coming back to the example, Meru Cabs was venture funded. I know the fund invested in them and so on. It was an innovative idea. So Meru was an upgrade over, or there would have been other kind of cab services in your city. So this is around 2000, maybe 9, 10, that these professional cab companies started coming into being. These were an upgrade over the typical yellow and black taxis which are there, because they had AC, they had a newspaper, they had water, they had drivers with uniform, there was safety, and so on and so forth. And then corporates loved them. So that was an innovation. But how did somebody like Ola beat them? These cabs still have to order. You have to put an order, or you have to get off airport and then book and so on and so forth. Now, and Ola did everything based on technology, and it was instant. You could see on the screen where the cab is, and so on and so forth, right? Now, this simple basic industry like ordering cab. Now, one might imagine what kind of innovation is possible there, right? And it's such a low value industry, low grade industry in a sense. And these were not even premium Mercedes or so on cab. You're looking at simple cabs, but somebody innovated there. And point being, then a company like Meru fell behind. You don't even hear of them, although it was funded with hundreds of crores, anyways, by good quality funds, because the concept itself changed, or a pager versus mobile, and these things happen. Or now you might end up seeing over the OTT platforms, Netflix, Prime, etc. Many are coming up versus TV channels. So imagine what would happen to a Tata Sky or Hathway and so on and so forth if everybody starts shifting to on-demand OTT platforms. So it'll be very tricky, because nobody will watch. And if that is going to happen, now one wonders what would happen to television. So of course, television, now the good part is even these OTT things we'll watch on television instead of mobile and so on. But these are the shifting trends. And hence, your company might be good. Tata Sky was not bad, is not bad. They had tons of programs and so on and so forth. But there's a shift in technology. Suddenly, somebody else comes and does something. So your Tata Sky is not dead. They are growing, but obviously they will not grow as much now. So that's where I'm seeing when you invest in a startup, when you evaluate a startup, this risk of partial or total loss of investment has to be looked at. Then the first point, illiquid investment, because obviously it's not listed share. You put in the money, even if it's not a loss, what do you do with it? You can't sell the share. It's shares in a private limited company. So that needs to be kept in mind. Uncertainty of exit. Yeah, you don't know whether you will get exit, when you will get exit. So that's a problem. You might think you will get 5x, 10x returns, but yeah, you may not get as expected. And then you might feel, I got 13% return after taking all of that risk. Had I put in stock market, I would have only got 15. So these things are something that you need to educate somebody who's putting in money in startups. Yeah. So if there are questions, please, I'll just check. Alan, if there are questions, I think you can directly, because I'm not checking the chat screen or whatever.
Nothing so far.
Nothing so far. Nah. So just if you can have a look and then pose it, you can just, I'll see you, once I see you unmuted, I will assume there's a question.
All right.
Okay. Right. So, okay, let's take a pause here and again look at it from our practice perspective. To recap, you will end up getting two kinds of business opportunities. Opportunity one is startups themselves. Opportunity who will come to you, and opportunity two is investors. If they are not directly coming to you, I think it's time that one can evaluate your ecosystem. And I've said later, how one can look at that here, which is there's institutes, for example, valuation course. That's a nice, it's tough, but it's a nice course to do. gives you a good sense of, so that's one service which can be provided to startups. But typically at that stage, you need a lot of, these entrepreneurs are going to need hand-holding. They are going to need some of these concepts that we are discussing here, and more we'll look at in the subsequent presentation as to how, they will need you as a friend, philosopher, guide, and so on and so forth. And so will the investor. So in this slide, we will now specifically look at what can you or what should you look at in a startup who might end up growing exponentially. And then, of course, you can provide him these services apart from regulatory of setting up and so on and so forth. How do you groom him, mentoring him, and take him to the next level? First and foremost is quality of the founder. Not all founders wish to grow infinitely. There are many founders, as I said in the very, very beginning, they'll be happy to just, what do you say? Maybe set up a shop or two, not set up a chain, maybe just be local players or at the most regional players and so on and so forth. But that's one. So a founder should have got technical expertise. A founder should have also, so he has to be a jack of all trades. A founder who says, no, finance nahi samajhta hai, that doesn't work. He should say, look, I don't understand finance. Can you teach me the basics? Okay. He shouldn't say, look, marketing, once I get funding, I will take a fancy marketing guy. No, he should know basics of marketing. He should say, no, if there's nobody, I'll do the marketing. So quality of founders, his spirit, at the same time, he cannot be egoistic and so on and so forth. So you need some of these qualities in a founder. Then it basically, one very critical thing, and this is how VC funds look at, venture capital funds look at startups. They like startups where there's a large market size, so that it can keep on serving. So as I said, car, food, clothes, that's the reason that many of these companies are getting funded, because it is infinite. Just India is like 130 crore people and growing. So media apps, news apps, anything which is, it's called in our industry consumption story. So imagine 100 crore people consuming stuff, and increasingly so. So market size is huge in a lot of these places. So all these consumer items keep on doing very well. Same, for example, in terms of many of the technology, apps, softwares, and so on and so forth, which make life simpler for people. So market size is critical. Then you have to look at what is the problem, what is the solution, right? As I said in the beginning, it may not be a very fancy problem that you are solving, not a very great technical, deep kind of a problem that you are solving. It can be very simplistic. So look at Dunzo as an app. So it just delivers stuff from point A to point B. Or let's look at Swiggy. What does it do? It's such a basic service that it's just picking up food and delivering food. Now, of course, they are doing a lot more things and so on. It's not complex. So if you see, interestingly, many of these most valuable companies have very simple products, and it is the simple products which get because the product is also simple for a consumer to understand. It also grows very fast, and it is useful to them. So the important thing is the solution should be such that it is easy to understand, it is very, very useful, and people may want to use it again and again. So if the problem has been defined correctly, you can look at whether it's a genuine problem. Sometimes people say, no, I will, instead of this, I'll help make things better and so on and so forth. But in just making things better, you have to check whether people want things better. So that also needs to be looked at. As an illustration, for example, a Meru cab or a very corporate kind of a cab service, which you have to order on the phone and so on and so forth, which is clean and everything, versus a local cab on an app. The local cab may not be as clean, may not be, the driver may not be as professional as somebody who's there in a corporate cab and so on and so forth. But so you can't say that, no, I will give you a better quality driver, wo cab bhi pehenega, dress bhi pehenega, wo cab, all of that. But a consumer, if he says, I don't want that, I want something which comes in 2 to 5 minutes. That's my need. So I'm okay with inefficiency in other areas if my need is satisfied. So that's what's called a problem solution statement. Have you understood the consumer's problem correctly? The consumer may be a technology company, he might be an ordinary man. So that needs to be understood and gone into. Then stage of startups. So typically, you will encounter people just at a PowerPoint stage where somebody just has an idea, or maybe somebody has done a prototype, a small sample, and so on and so forth. So when you are evaluating as a chartered accountant, a client who comes to you saying either I need funding, growth, etc., typically, unless it's a very fancy technology, some deep tech, really innovative idea, and so on and so forth, it is difficult to get funding at a PowerPoint stage or just an idea stage. Also because then the investor says, or the VC fund says, what has the promoter done? If you haven't put in your risk money, if you haven't borrowed money or put your own money, then why are you putting my money at risk? You take effort, you get out of a job, you work, and so on and so forth, then you do something. Otherwise, it won't work. So, so stage is important. At least the prototype should be ready. It should be out in the market, few hundred, few thousand people using it. So that is the stage at which it makes sense. But as a chartered accountant, for taking up advisory or audit role, or if you feel that is an interesting promoter, the first few quality, market size, problem solutions are good. Funding comes later. Then you can sign him up. You can identify such companies, work for them, advise them, either as an auditor or as an advisor, and so on. Then sometimes what happens is the promoter comes saying that, look, I have a fantastic idea. I will sell 1 million of these products and so on and so forth. But I need like 10 crores on day one. So that many times very rarely happens unless he's from IIT, he has a previous startup or IIT IIM or a fancy institution or a corporate experience in that field. So it's otherwise very difficult to get such kind of money very early on. Then incidentally, whether the startup has got some other backers. So sometimes it can so happen that a prominent businessman has backed him up or has agreed to back him up. So that becomes a key thing for you to look up, and those startups become very fundable immediately. Then lastly is you might have a great idea. So for example, somebody says, look, I will create another Zomato-like app and it is better in this way, that way, and so on and so forth. So again, that cab like will come into play. A company which has got maybe 10,000 crores in its bank account right now, okay, can fight you off. So even if your idea is better, it's very tricky to fight such, large, large corporates now, which were startups earlier. So that has to be looked at. It just can't be say something better than a Zomato. So that's something that we look, and that's the reason you don't see many apps in that space coming out, hardly any, because they know that it's very difficult now to compete with some such people. So probably something, if you want a cab service, now somebody innovatively can start up, let's say, electric car ka fleet. Now that could be, and then people might want to go for it, and so on and so forth. As I was saying, how does one evaluate, or where are these startups? How can you find them? So one is, of course, with extended DA. So you might be, for example, in a BNI, or you might be in Rotary or Lions, or whatever of these, or C Institute. Your friends might be working somewhere in the corporate field, etc. So one has to constantly activate his network with the focus of being connected, of reading out startups, and so on and so forth. News sources. There are a couple of very nice blogs which are now news sites themselves. There's something called as VCCircle.com. There is Inc 42, INC 42, and so on. They give daily updates free of cost in your inbox of startups, investments, etc. So I think you should subscribe to them. And of course, there are newspapers like Economic Times and Mint and so on, which also have now dedicated startup sections. So one is you need to have this knowledge, and then of course local knowledge. It may not be from your city, it might be from surrounding cities and so on and so forth. But I know for a fact that your state has a very healthy startup atmosphere, and startups are encouraged and so on and so forth. Then of course there are networks like LinkedIn. There are investment bankers like us, so you can, again, through LinkedIn or directly network with iBankers who constantly work with startups. There are these startups. If you just Google a Kochi startup competition and so on and so forth, I'm sure you will get hits and so on and so forth. And some of these might be companies known to you for that matter, or known one-off to you. So that's something which can be looked at. So these sources you can explore. for identifying startups? Yeah. Then we have to look at this is an area where anyway, if you have an investor who wants to invest in a startup, this is the due diligence that broadly you need to do. Also, this is a professional opportunity for you. If there is a startup that you have, or if there's a fund which wants to do a due diligence of a startup, so it may not be even behalf of a fund. These are the things which you can do for a startup and charge him for getting him ready for all of this in the first place, because even that's a task. So, for example, one is obviously legal due diligence. So that includes legal, secretarial, everything, right? From the setup, incorporation, minutes, patents, copyrights, agreements, non-compete, all of that, evaluating, those kind of all legal arrangements. Then technology, you may not be directly able to do, but probably you can if there's a friend in the tech space, somebody running a software company, etc. Because then people do check up whether is it is a startup working on obsolete technology. So, for example, if you're now anything which you're now building, an app and software, etc. If it's in the consumer space, it at least must have a artificial intelligence component. Earlier, as you used to say, आपका business है तो website चाहिए, for example. Now those days are gone. Now then they were dynamic websites. Now you need AI to be built in most cases, because otherwise it's a dumb portal, and AI is very expensive. So technology, whether it's latest and whether it is for the future, etc., that needs to be checked. Then business processes, payroll, accounting, whether they are online, taxation, paid on time, and all of those. So effectively, all of those business processes needs to be evaluated, set or evaluated. Even if it's a partnership firm, LLP, etc., whether they have a reporting format, whether analysis is happening of the metrics, not just values, but numbers, user growth, user drops, all of those. Then call HR, quality of human resources, attrition rates, if possible, benchmarking with other startups, 2 less, 2 more, all of that also needs to be checked. So complete client diligence, dependence on top 3 clients, depending on number 1 client, depth of ये कितना free service दे रहे हो, geographical breakup, industry breakup, all of that as a diligence can be looked at. Then, of course, financial itself, which is P&L, balance sheet, MIS, and so on and so forth. So these are the diligences that you have to do on behalf of the investor, or if the investee, that is a startup, is your client, then you can do, help him get ready for that. Yeah. Okay. So when it comes to financial analysis, what all can be done? So this is from the perspective of pitching a startup to an investor. Now, what all needs to be looked at? So first is a 5-year annual plan, not a 2-year, 3-year, but a very robust 5-year plan, saying like some of you would have done project reports for banks and so on. So 5-year plan, a 1-year monthly plan. So 12th month, because assume that investment is coming in, then investor would like to know that at least 1 year should be very, very clear. If just a few months ka clarity chahiye of exactly where the money is going, what is happening, and so on and so forth. Then in startups, remember, this is very, very important. More than profit and loss, cash flow is critical, because most startups die because of lack of cash flow. Cash flow, obviously, as we all know, is a combination of the investor money, maybe on some loans, and inflow. So managing that becomes critical, because in case of many startups, they might take off after 12 months, 18 months in terms of business, etc. So idea is that the money should be managed properly and the money should be in the bank. Very importantly, assumptions of revenue and costs are the key, because ultimately it's risk money which has been put in. Now, if you make too fancy assumptions, lower in terms of cost, higher in terms of revenue, it's a problem. So, because month on month, as I said, just to take 2 points, above is 1 year monthly plan. So in the second or third month itself, you will start facing a problem if the assumptions are not right. Then a capital expenditure budget separately, because generally investors don't like too much investment on capital expenditure. These days, everything from furniture is available on hire, computers, and so on and so forth. So what capital expenditure does, it blocks capital, and whether you buy a 60,000 rupee computer or whether you pay 3,000 rupees rent on the computer, the output is same. So why spend 60,000 rupees? You are spending 20 times more, and this is how investors think. Okay, when initially the capital is going to be scarce. So the whole idea is to manage the cash flow very well, and capex budget becomes very critical. Only if needed, one spends on capex. Then come the fundraising assumptions. कि कितना पैसा लगने वाला है, when is it needed? Well, it's then net result of revenue, cost, how much money you're going to lose, because startups most will end up losing money in the year and a half, and that's the reason that they need funding in the first place, to fund their revenue expense. A manufacturing company needs typical money for capital expenditure and setting up plant, machinery, and so on and so forth. And it might break even in a few months, but here it might end up losing money for several months or several years for that matter. So that's something which needs to be kept in mind. Then after the investment is done, and we'll take a short, it's 5 o'clock. We'll, after this slide, this presentation is done, we'll take a short, Alan, we can take a short break after this, right? Take a 5-minute break and then. So after the investment is done, this is another good professional opportunity for all of you. If you know VC funded company, or you can pitch to them, which is tracking business plan versus actuals. That's something which is needed by all of the startups. Key business parameters, as I said, we got even CAs in Pune who are tracking and putting on Google Drive. So that all investors, there might be like 5, 6, 10 investors. So all of them, it's very difficult to mail and so on and so forth in whatever format you send. But basically, the month-on-month numbers, ratios, key metrics of that industry. Each industry will have different metrics. So a car industry will have number of rides, number of hours, and so on and so forth. A franchisee business will have number of franchisees and so on and so forth. So different businesses. So those key parameters need to be tracked. Key deviations have to be highlighted, because one of these deviations might end up being a killer for the organization. So for example, if month on month we are seeing there's an attrition of people, or month on month we are seeing that if it's a franchisee business, a couple of franchisees are losing money, or maybe all are losing money, and so on and so forth. So that needs to be looked at, the key deviations from the plan. Then see, business is dynamic. So if not a full product or service, features might keep on getting added to the app, to the store, or a product, or whatever. So that progress has to be informed to all the investors. That has to be tracked. The plans have to be updated accordingly. So that's again good amount of work. Similarly, if there is good growth, a startup might say, look, I've started with Kochi, but now let me go to Pan Kerala immediately. Let me go to other cities in India immediately. So new regions added, reasons for that, whether there's money for that, all that. Yeah. And similarly, key people added. So tracking all of this, monitoring it, giving explanations for this, informing investors in one or the other format, that is something which a chartered accountant can do very well. This service, by the way, can also be given to mid-sized companies who now got multiple directors, shareholders, etc., or family-run businesses with multiple family members. this is also good service to give on a monthly retainer basis where that tracking can be done. And the advantage for them is a independent person. Instead of just one family member running it, if there are multiple people handling multiple aspects of a business, then each one will have a standard template, standard report in front of it. So that's what I have to say in this. There's one more presentation, as I said, which is out there. We'll take a short break and then restart. Is that okay, Alan?
Sure, sir. Whatever works for you.
Sure. I'll just set up the next presentation and then we'll just start. 5 minutes. It's 5:03. So we 5:10. We'll restart.
Okay.
Questions till this stage?
Nothing so far.
Nothing. Okay, great. Right. So we'll tackle early stage startup funding. What we're going to do is this is something which will be very, very practical for you in terms of if you get a client. This is more like a ready referencer of 10 simple points that you can go through, and then you'll be able to start the startup practice as well. So for the first question which comes up is the legal entity structure, and then there are all kinds of misnomers. Private limited company kare, proprietorship kare, and so on. So we generally recommend that just proprietorship is not recommended. It doesn't give a professional feel. Although it's a small entity, because even startups come, they are very, very small. And all of these things, partnerships, LLP, have a cost attached to it. Maybe a few tens of thousands of rupees, but they have a cost attached to it. So then promoters are tempted to do just proprietorships. So first of all, a proprietorship partnership is not recommended. If there's a serious problem, then okay, a partnership is still okay, because it's still own money at this stage. And a private limited company need not be started off with, as CAs, we anyways know that the compliance of limited companies, even private limited companies, have grown significantly despite ease of doing business. There's lots one needs to file and so on and so forth. As also there are a lot of penalties involved. So you can choose between a partnership and LLP. If the client is ready for LLP, it is ideal, because if he has to get funding, then obviously shares have to be issued and it has to be a private limited company. So, and then it's much easier to convert a LLP into a private limited company. A partnership to a private limited company is a slightly longer process. And that's the reason we recommend that if the client is ready, go for an LLP. Another advantage of LLP is the first investors can also come in as limited partners. Compliance are obviously lesser, and it gives a professional kind of a feel. So that's point number one. Go for LLP or LLP. There is no need to start off with the private limited company to begin. because it might so happen that the business doesn't perform well, needs to be shut down. Again, that's a problem, shutting down a private limited company and so on. There's problem in taking funding, even putting in own funding, etc. So best to do an LLP to start off with. This is a big question that we get asked. That if there's somebody, should I take, is it necessary that I take a co-founder that is a partner? Like a partner in a startup is called as a co-founder. So let's look at the pluses and minuses of each. So incidentally, if it's 2 or 3 people starting, anyways, there's no problem because they are anyways together. If it's a single person starting, then what should be done? So what's the plus? A plus is if he happens to get a co-founder, then he can come with a different skill set. So somebody from the technology field, somebody from a management field, technology and finance, or management and marketing, and so on and so forth. So different skill set, different experience set. Somebody who's worked abroad, worked in India, that can be very interesting. Which, as I've said, next reduces the risk significantly, to people. And of course, on the positive side, can lead to better management of the company where responsibilities are divided. Then on the negative side, the equation is very critical. Just because your college friends, school friends and all doesn't mean that your business relationship will be okay. So that needs to be sensitized, because in business, sometimes calls will have to be taken, decisions will have to be taken. So the temperament of the person is very important. So see, all of these issues are not finance issues. These are soft issues. But if you want to advise in this area, if you want to work in this area, and if you can talk this language, it's much more interesting to the client. So the investor knows you understand many more things than just typical stuff. And so yeah, the investor also understands, and the client, the startup understands. Okay, so if you have to take co-founders, how many co-founders? Okay, there's no magical formula. There are companies with 5-6 people also as co-founders and so on. So depending on the nature of the business and so on. So if it's like international as well, it could be that there's somebody who's now permanently settled abroad, there's somebody here and so on. But 2 to 3 people is generally a good manageable number, is how we look at it typically. Okay. Again, a literal $1 million question. What's an angel fund or angel round? Angel is basically a person who's got money and invests in a startup. So he literally comes in as an angel and saves, in a sense, the idea or venture. So that's why it's called angel fund or angel round. Nothing but a fancy name for a rich person and who's willing to invest as well. So when he invests, it's called an angel round, or it's a group of people. Typically, many times people put in, like, say, 5 people can put in 10 lakhs each or 20 lakhs each and so on. So that's called the angel round of investment. So the question is, your client has started a business. Should you immediately raise a round? Should you wait? What's the idea? So number one, as I said in the beginning, make a 5-year plan, make a 12-month plan. If you need money to finance that, and your founders put together have got 20 lakh rupees and you need 50 lakh rupees, you need angel funds anyway. So there's not a question. So you have 2 choices: either run the business for a few months or don't risk, early stage itself, try and raise capital. So it depends on the need and nature of the business. If the business needs money, you have to raise money and go to angels, pitch to angels. There is also something called the friends and family round, which is typically what an angel fund will say is, you got an idea. Have your parents invested, uncle invested, friends invested? Okay. If you haven't been able to convince them for whatever reason, okay, so it's not necessary. Then, why are you coming to me? So it's not necessary to do a friends and family round, but if you can do a friends and family round, it creates a confidence amongst external investors, unknown investors, that look, your own people trust you in the first place with money and so on and so forth. Although their level of checking due diligence will be much lesser, because they will trust you, they'll put money on you on face value and so on. So then there's this angel round. If you need it, if you can delay it, go take the product to market and do it after a while. So the later you can do it, the better, because the valuation you get might be better and so on and so forth. But if it's needed, it has to be done anyways. But if you're doing it, don't do like 1 lakh, 2 lakhs. Ideally, 10 lakh rupees, if not 5 lakh rupees per investor, will become difficult to manage. As CAs, you know, there's a compliance, there's a shareholder list, and so on and so forth. So you have to take signs. If there's a shareholder agreement, every time you have to take signatures, etc. So that becomes a problem. Angel round, yes, if it's needed, do it, and there's nothing wrong in doing it early. Tell your client, the startup, that don't be greedy. Even if it's a less valuation, the business needs money, you have to raise money. Which brings us to the next question. Okay, many people say, what is the timing? So like stock market, we always say that an intelligent guy, a smart investor or a trader, he doesn't time the market. Now it's too high, now it's too low and something. There's opportunity in every market. Similarly, in VCs, there's no right or wrong time. You have to raise the money, and that's your role, very critical role of a chartered accountant, where you understand cash flow. The promoter can look at, the promoters are always bullish. They are always optimistic. So they will feel that, look, my product, if my product or service works, I'll get sales revenue, then I will not need money, etc. But you're telling, what if it doesn't work? Then at that stage, people will not give you money because you would have failed. So do a plan, do sensitivity analysis, that if it doesn't work at all, if it works at 50% level, how much money will you have, and so on. Accordingly, then time it and then try, because even you don't know whether you are going to get investment or not. Even that's a risk. So accordingly, raise it. But typically, if you can, as I said earlier, at just a PPT stage, it is very difficult. That I have an idea, I need money. The minimum stage which investors look at, and minimum stage at which you should let your investor or client invest in a startup, is there's at least a POC, as it is called, a proof of concept, or if it's a technology product, it's called as a minimal viable product, or any product that has to be made by the startup, by the founder. Because if even that is not there, then it's very, very risky. कि वो product ही बनेगा कि नहीं is a problem. Versus if you're designing an app with 10 features, an app with 2 features, low grade design, without artificial intelligence, can still, but a working app which has got few hundred, a few thousand users, is what we call as a minimum viable product. At least it works. So that is something that you need to look at, and post that is generally a good time to raise money. As I've said, if there's revenue coming in, then of course, ulta bhi hota hai. Many people have got that fancy of raising venture capital money, angel money, etc., etc. There you need to advise, if you're doing well, then if you can postpone the funding and you're getting good revenues, etc., you'll get better valuation, better quality of investors, higher grade investors later. So just for the sake of it, don't raise money. Ulta bhi ho sakta hai. Yeah. So good time is when you're on the rise. That business is established, there's a product in place, thoda revenue has started, or growth, may not be revenue, but growth in numbers has started, etc., is when angel funds and VCs will be excited that this is on a rising path. Yeah. So again, $1 million question, how are early stage startups valued? So it's a complete art. It's not I mean, of course, there's a science, and as I said, there's a course that typically all of these are on discounted cash flow basis. Most of us have studied this in financial management. So yes, because hardly any of these are profitable. Even if they are profitable, the profits ka multiple may not reflect the true value of the startup. So it's of course a DCF which gives a, now typically a few things to remember are, one, that because we have a 10-year-old, at least, I mean, it's a 25-year-old startup system, but a 10-year-old very active system. Now there are benchmarks established. So right, like there are price to earnings ratios, etc., established in the stock market, and industry has so much. And if your company needs a higher price to earnings, it has to be justified. It's better quality and so on and so forth. Similarly here, if it's a platform, it's e-commerce platform, it's X times of revenue. If it's a financial fintech company, for example, distributing loans, it is so much multiple of loans distributed. So these numbers have been more or less for many industries established. So one is DCF, but a DCF basically is based on projection, right? That आज 1 crore है और 3 साल में 100 crore है. Now that will give a number, but these numbers will also be looked at as how are the comparable startups doing. That will also be evaluated. And then there'll be a comparison of the two. There'll be some average or it'll be closer to the industry benchmark and so on. Then intangibles such as quality of promoters, number of VCs. So imagine a startup in which 3-4 VCs are interested. That can come under premium. It can get a higher valuation, right, versus a normal year. So again, ulta ho sakta hai ki DCF valuation can give X value, but because there's a high level of interest, there's a high buy. So there's that buying selling feature of the market that will anyway kick in and come into play. So these are the dynamics which come in. So when again startup guy comes in, then many of these promoters have fancy expectations. They have to be told it's not just DCF. Just because I have shown an Excel sheet that will be 100 crore, on that basis, suddenly I may not get valuation. All of these other factors will also come into play. We also tell people don't compare. Somebody in the industry has got suddenly a $100 million valuation. Now, there might be a better quality management there. There might be people who have been part of earlier startups there. They might have some other marquee clients there, which make a lot of difference. So there's no comparison in that sense. So that needs to be looked at. A big question which comes up is employee stock option plans. And this is another very good area for CAs to work in who are also interested in secretarial, or you can also tie up with the company secretary or study yourself and design these ESOP plans and structures that startups typically 5 to 10% of the, it's called an ESOP pool, that those shares are set aside for giving to early stage employees and even later stage key employees. Sometimes all early stage employees get it, and then later on key employees get it, and so on and so forth. So this it's a standard practice. If it's a startup going for normal startup also, because salaries are not so high, you pay less salaries and people are taking a risk with you, you may go down. So they say, look, I will give you 0.1%, 0.25%, as stocks and so on and so forth. So should you give? Yes, you should give. Then to whom to give? Initially, you have a CTA, CTO, CFO, product manager, some key people without whom your company would not work. Those people should be given these ESOPs. Also, at the same time, if you give them too early, it's a problem. So there has to be some commitment which has to be taken that, look, you're 6 months old and you give ESOP. So the ESOP plans also have a vesting plan that if you are given 1% shares, it is like 25% shares get vested every 4 years, and wo hota hi hai. So probably you can have some plan where till 1 year there is no vesting. So at least people say, or till product launch there is no vesting, and so on and so forth. So otherwise people will just take it and leave. So that needs to be prevented. But if these are in place, even the VC understands that you're a professional company, you understand the dynamics. As I said, human resources are a key play in this. So those resources will get. If you have a mode of retaining those resources, then of course VCs are also happy, and again that's a part of valuation. So you'll get a better value as well. I have been using these terminologies over the last hour or so. So typically, what are these rounds? Many times you will see a news which says you've done so and so round and so on and so forth. So there is founders capital, which is own contribution of founders. There is friends and family, as I said, funding from people known to founders. There is angel round, which we spoke about. So typically, angel round is 2 to 5 crores from angel investors. There are networks, so you would have heard of these called Mumbai Angels, India Angel Network, and so on and so forth. I don't know if there's a Kochi network. I'm just trying to apparently check up. So hello. Yeah. So these angel networks also is one key source of funding. And there are new term called micro VCs where they put in like 5 lakhs, 10 lakhs, very small capital. Then there is something called a seed round, typically 3 to 7 crores from super angels. So some of these people who have made either very, very rich people, HNIs, who are worth hundreds of crores. And typically these angels put in 10, 20 lakh, 25 lakh each. But here a super angel can put in a crore or 2 crores or 5 crores himself. So that's a seed round after angel round. Then these rounds are named after alphabets, A, B, C, D. So first is A and so on. So all the institutional rounds where you a VC fund, a venture capital fund, or a private equity fund puts in money, they are called as, then that's the first space where this is called as a Series A round. That's a 5 to 15 crore round. So there's a pre-series round before a Series A. There's a Series A 15 to 50 crores and B, C, D, E, F, etc. So if you read the news of Swiggy, they will probably Series F, Series G, and so on going on. A subsequent round is named accordingly. So these may not follow a pattern. So it might be founders capital, company grows, and directly Series A can happen. So ऐसा नहीं है कि you have to go through that sequence of friends and family, angel, and so on. There might be sometimes founders capital, seed round, and directly Series A round. So that's all of those things happen depending on how the company grows, what is the stage of the company, and so on. Yeah. Sorry. Typically, a key question is, what are the returns and exit expectations of investors? Now, although these are not fixed returns, you're not assuring somebody of 18, 20, 24%. But typically, and different investors will have different expectations. But definitely there will be multiples of not 10, 20, 30%. So typically the expectation will be, if I'm putting 1 rupee now, then in let's say a couple of years time, that one should become like 3, 4, 5 rupees. Okay, that's the expectation. So IRR, ROI might be like 40, 50% kind of. And again, the expectation is that I will get a 3-year exit and so on and so forth. How will I get an exit? A VC fund, a Series A guy will buy out the earlier ones. That's the way it typically happens because they don't want so many investors on the share capital table. So it's called as a cap table. So that's the reason. VC funds invest for a 4 to 6 year horizon. In between, if there's a Series A guy, he might dilute in Series B, or he can put additional money in Series B. So all of that is subjective, goes on. So depends on subsequent rounds. Earlier, people can keep on getting an exit. It's not compulsory. Some people might say, I'll keep on continuing. Nobody can force them, but many can take an exit, and that cycle continues. So, but as the rounds grow, the return expectations go down. Obviously, because the risk goes up. You're not going to come in at Series A and expect a 10 times return, although you might get a 10 times return. That's a different thing. Then, when you are making an investor presentation, what are the key points in an investor presentation? So number one, there's a short exit summary of up to 8-10 slides, which just gives a key idea: company, product, opportunity, money required, competition. So that investors don't have time for like 30-40 slides. And there's a larger slide where you'll explain the process, flow in detail, product features in detail. So the short presentation will just have, look, this is the product, key features. The bigger one will have maybe 3-4 slides, photographs, and so on as well. Then, as I've said there, key, what all will be included? Key problem opportunity, problem solution, market opportunity, the product, service, USPs, founders, go-to-market strategy, competitive landscape, financial summary, investment and use. So where in a nutshell, in like 15 minutes, 10 minutes, the potential investor understands the proposition and he can actually have an opinion saying, look, I'm interested for a larger presentation. And as I've said, each of these can be then given in detail in the bigger something which is called the investment memorandum. Okay, we come to the last slide where and then there's Q&A. I had left some space for that. Key factors that VC funds look at, and that's the slide which we started of quality of the promoters, size and growth, product or service of the company, technology, quality, pricing, nature and stage of competitors, amount of funding needed, and reasonability of valuation. That's the thing based on which. So the very first point where I started, I give you a generic view of what do we call a startup, incidentally. But here I am looking at what do investors specifically look at. So these are the items that they will focus on before putting in money. So these are the points I wanted to share with you. If there's any doubts, my email ID and any of this presentation I will share. It's there. So feel free to reach out. We are very, very passionate about this. We've been working on this, as I said, actually with the companies and with you. So questions, queries, etc. are welcome. Anything which can help you increase or build on your practice is most welcome, because I think that's the need of the hour. In conclusion, I can say that this decade, 2020's decade, one must focus on this area, because now startups are going to mushroom. Kids who are now in college, and so the millennials, as we call them, right? So imagine that a kid who's there, who's read about the Zomatos and Swiggies of the world, will also dream of starting. So earlier, only specialized people were starting, but now people. I also worked with the Pune University on their incubation center. So now we are seeing that campus startups are coming up, and a lot of recently we also invested and advised a company which was started by 3 students. They were in the 3rd year of engineering, and by the time they just got done post engineering, they got a valuation of 5 crore rupees and raised 50 lakh rupees, and they are today valued at multiple times that number in a matter of months, basically. It's a fantastic product. Colleges are adopting it, and so on and so forth. So you will see, if you're taking sessions like these in colleges, at local colleges, engineering and so on and so forth, you will see a lot of enthusiasm, interest, which was not there. We were not seeing this 5 years ago, because now people believe that even a college kid can be funded tens of lakhs of rupees. There's an ecosystem. There's this Atal mission which is going on. So government is keen. So I think we just need to increase our scope of looking at this as a segment. And it is not just about funding. You've got advisory while setting it. As I said, the simple advice of what kind of entity to set up. People are confused. Then things like missing out on ESOPs. There can be collaborations with a company, when to give. All of these can give professional fees, right? From advising to setting it up. And the promoter will be thankful for it, because he knows that he needs this. And if he has this, only then he's going to get VC funding. Making presentation, making projections, updating projections, making monthly information systems, robust systems and reporting systems. Then valuations, pitching to investors. So you can see there are like 9-10 areas where, as chartered accountants, we are uniquely positioned to give services. We just have to open our eyes, network more, work from, not just colleges. There are people from industry who are leaving after 20-year job, 25-year job, have an idea, want to start up something. And those are also getting funded because they have the deep expertise and knowledge of that industry. So as I said, Kerala, it could be aquaculture, sericulture, travel and tourism. It could be anything to do with anything green. Kerala is known for a lot of these green products, environment friendliness and so on. So there will be so many activities which one can look at. So it has to be also state specific, city specific, where one can explore opportunities, keep eyes and ears open, network there, and then keep on getting clients. So I think with that, I once again thank Ranjit for this kind invitation. We'll keep the floor open for questions. I'll be very much here. And I thank the Ernakulam Kochi branch for this invite. Thank you so much.
Thank you, sir. So we have a couple of questions. Shall I just read it out? The first one is,
Yeah.
is there a thumb rule for valuations? For example, is it 5x the profit before tax, or is it equal to revenues? Is there a thumb rule that people can
None.
use?
So there's no thumb rule for valuation. It is completely dependent on the company and the industry. So rules have emerged based on the industry for sure. Okay. So, but industry, they will differ.
Okay. Another one would be, how would someone approach an angel investor or a VC? Is there a...
Okay. So we'll split up this question into two parts. Angel investors are actually technically not advertised anywhere, right? So they are, yes, they are not there. So you can probably check on LinkedIn and start building a network. It's a time-consuming process, takes years and years, can take years, or can click immediately. But point being, so that's the reason that you can go to an angel network like a Mumbai Angels and India Angel Network, which is a pan-India. Just write down India Angel Network and Mumbai Angels. Also, there's something called an angel list. You can just Google India Angel Networks and you'll get multiple links. Okay. So what are these networks? These angels have come together and form like ICAI or like a local chartered accountants society is a informal society. They have formed these associations and they have formed a small secretariat and they have a website. So you can get email to them, they will evaluate and so on and so forth. At a local level, you have to build your own angel network. So there might be a jeweler, there might be HNI, there might be a successful entrepreneur. You have to somehow try to reach him, get to him, and that's how you have to build it. VC funds, if you do not have a connect, the best way of connecting is LinkedIn anyways. You have to send request, send it, because there's no other way of reaching out. Or, for example, if there are local investment bankers there or people like us who are connected to, because over the last 10, 15 years, we have built up this network of hundreds of VC funds. That's how you build a network. Or you approach somebody like us, you will have local iBankers there, you'll have in Mumbai in your network or whatever it is, saying, I have an opportunity, I want to pitch, and then you can explore and work together.
All right, so I think that's it for the questions. If anyone else has questions, please post it in the chat box, or you can post it in the Q&A box as well. So we have another question that's come. So the question is whether vesting period and promoters lock-in period are the same, or is there any difference between the two?
Oh, so promoters lock-in period is generally applicable in case of IPO. It's not typically applicable in case of VCs. Although there's, of course, in VC funds, anyway, there's a clause that promoter cannot sell its shares anyway. So forget lock-in. He just can't sell its shares. Okay. So it's not that you can lock in for 3 years. So if there are VC funds coming in, before they sell their shares, a promoter cannot sell his shares. When there's an IPO, there's a lock-in in which there's a 1 year, 6 months lock-in. Mostly it will happen 1 year, but till 1 year, promoter can't sell his shares in post IPO, and then he can sell. Now, vesting is ulta. Lock-in is where you already have shares and you can't sell the shares. Vesting is where in ESOPs you have promised shares to an employee. Okay, that you will get 1% shares. But instead of, so today you give 1% shares and in 6 months he leaves. What will you do? Right? So what you do is you tell him that, look, you will be entitled to 100 shares, but 25 shares will vest with you at the end of year one. I mean, 25 shares will vest with you at the end of every year. Okay, so he has to work with you for 4 years to get 100 shares. That activity of he getting the shares is called shares vesting in him. So if he leaves at the end of first year, then the 75 shares are unvested. They are gone.
That's it for the question, sir. We have another one. Is that mandatory to provide an exit route for the investors with assured returns?
So, in fact, you shouldn't assure anyway, as far as the company law is concerned, etc. If you issued equity, anyway, it's not mandatory, right? Because it's equity and they are locked in. But if you are taking money where the investor is, if the company has promised in so many years so much return, then technically that is not venture capital investment. That is technically debt. So we advise people that don't take such money. It is very risky for you. Where will you pay the money from? That is a loan, right? Anything which has a repayment period and a repayment amount and fixed returns. What is it? It's a debt. It's not equity. So ideally, you should not take such money. It is extremely risky for you and it will be your liability. So better not to take the money. So it's not mandatory. You have a choice of not taking the money.
So could you explain vesting of promoter shares once again, and is it mandatory to include it in the term sheet?
No, so as I clarified, promoter share, there is no question of vesting. Okay. Imagine you are a promoter, you have set up a company and 100% shares are whose? They are yours anyways. Okay. So in any case, and then a fund comes in, takes a 20% stake, you have got 80%, fund has 20%. I was explaining vesting. So yeah, okay, there is also vesting of promoter shares. I will explain in a moment. But typically vesting applies when you are giving shares to an employee where instead of giving all shares upfront or today, you give him shares in part over 3-4 years. And when he gets the shares, they are called shares vested in him. Now, when VC funds come in, sometimes they also refer to vesting of promoter shares. Maybe he's referring to that. What they do is they say that although technically you have got 80% equity stake, okay, we will lock up 60% of your stake to 3/4 stake. We will just, so let's say out of, you have got 80 shares, somebody and the fund has got 20 shares. Out of 80 shares, they will say that you will notionally get 20 shares each and then be entitled to, otherwise the 60 shares will be locked in. And so that you tomorrow don't run away. As the promoter, if I resign from the company or if I stop here, what will happen? So that is called, there is sometimes also vesting of promoter shares, where he gets entitled to those shares, okay, once number of years are completed or milestones are completed. But generally vesting is for employee shares.
So next question is there an agreement between the promoter and the VC?
Yeah, that's a good question. It's called as a shareholders agreement and a share subscription agreement. 2 agreements happen. So there is first a term sheet. Term sheet is a 2 to 8 page document which quickly lists out all the terms. It's like it's a summary agreement. It is not technically, it has no legal value. Okay, a shareholders agreement and a SSA gets incorporated in the articles of association, so it has a legal value as well. Term sheet is idea is it's like a in principle sanction of a bank, or a sanctioner of a bank. So bank also gives a sanction letter and there's a loan agreement. So term sheet is like a sanction letter. Even if you sign it, it can't be beyond the point enforced. But the idea is to let you know all the terms. Then there is a shareholders agreement and there is a subscription agreement. Subscription agreement is where you say that, look, I am subscribing to so many shares at this value, these are the terms and so on and so forth. And in shareholders agreement, they list out all of the responsibilities of the promoter, director, what are the events of default. So basically shareholders agreement is agreement between shareholders. So there's a promoter as a shareholder and investor as a shareholder or fund as a shareholder. What are their rights? What are their information rights, visitation rights, audit rights? All of those rights and obligations are listed out in a shareholders agreement. So these are signed up and these are mandatory. They are binding. They become part of MOA AOA.
Right, so the next question is, if a company has been in their respective industry for over 10 years, having organic growth and sufficient profits, what would be the best route for them to source capital to achieve inorganic growth? Can they go straight to an IPO, or is there any advantage to doing a VC round first?
No, so anyways, companies which go IPO prefer a private, it's called a private equity. So a big brother of VC is called a private equity fund. They are the same, but somebody who puts larger money is called a private equity fund. Other equity money only. So many companies prefer private equity funding before going public. There is no rule or there's no bar that you can't go directly public for a few reasons. Number one, valuation gets established. Number two, credibility gets established. Okay, that a PE fund has put in, because a PE fund will also do due diligence. PE fund will check all of that. Three is that a cleanup will happen because the board will get established. All of the things which are like pre-IPO, all of those things will happen. Then if you do IPO, it will be easier for you. If you directly go IPO, then you will have all kinds of questions. Versus if there is a, then 20% questions will be less. The company that somebody has believed in you, a good private equity fund. So it's always better to do a PE round before an IPO.
Looks like that's it for the questions, sir.
Okay. Yeah, we almost done 550. Yeah.
Thank you very much, sir. That was an excellent session. A lot of this was new territory for a lot of us. You've given us a great deal of clarity on what to look out for in a startup and how we can advise our clients.
Thank you.
I'd like to ask our chairman for some closing remarks. Also, before that, we have another question. Do we have to give projections to the investors?
Yeah, we have to. As I said, a 5-year projection. These are not binding, but they have to be given. They have to be justified with assumptions. Those can be random projections. So you have to, justify each and every number in them.
Thank you, sir. Chairman, would you like to add something?
Should we wait for a couple of minutes in case somebody has any questions?
Sure. So in the meantime, dear members, we have 2 more days of learning coming up. Tomorrow, our session is on equity investing for wealth creation and investment advisory to clients. And the day after, we have a session on real estate investments, investment trust and infrastructure investment trust. Okay, our next question is coming. What all exit routes can offer to angel investors? Is it buyback or offering their shares in the next round of VC funding?
Yeah, I also put my email ID and number in the chat box. And I'll share the presentation meanwhile. Okay.
So,
buyback. Typically, buyback is not a great route. That's why I'm saying that if you are advising investor A, see, because buyback means indirectly debt. Okay. Don't get your startup client obligated to any returns. And that's the reason in one of the first slides I said, make it clear to the investor that this is risk money, that you put money and you don't have a parachute. Oh, it will like, if you want expected returns of like 10x, then be ready for a 0 also. Don't ask for a buyback, guaranteed return, वगैरह वगैरह वो नहीं मिलेगा. Okay, if that clarity is there, okay. So what are the exit routes? Exit routes for angel investor only is when subsequent rounds happen. Okay, then not necessarily even in the next round, because the next investor will say, I will not spend my money and give an exit. I will put money in the company. So it might be seed round, or generally seed में होता ही नहीं है. Typically pre-series A or series A rounds में first investors get an exit. See, because even the earlier, the second round also might become like a crore and a half round, and he might say, I will not give money to for exits. So tell your client that exits are only from subsequent rounds, or if you wait IPO, or yes, the company might be bought over. That happens. That's happening quite a bit these days. That you build a company and a larger company writes a check and buys you. So I think that clarity and education. See, if you're starting this afresh, I think this clarity is important. I think that's the reason that I think sessions like these could be useful. Is where first of all the startup has to be educated. Like I said, educate the startup on valuation. Don't have fancy expectations. Tell him that don't look at these fancy things like 100 million valuation and so on. It's a lot of grunt work. it is very systematic work. As somebody asked, there has to be presentation, projections, systems in place, ESOPs, people. ये ऐसे ही नहीं पैसा मिलता है. Like you have to take the effort of doing of course, all of that may not be available in the first go. That I understand. But the promoter should have the orientation of, he should not feel it's irritation that somebody is saying do this. He should have the mindset that I want to build a large enterprise, and then I should work accordingly. Okay, you should be ready for getting on tens of calls. Be very patient. Be very humble. Okay, he cannot say I have a fancy idea. Koi bhi de dega. Nahi. If you see the best of entrepreneurs. So I had an opportunity of being on a panel with Make My Trips founder. He said we went to some 40, 50 investors, most successful entrepreneurs. Okay, have easily gone to 40, 50, 70 pitches. You never know who's going to give you money. So I think that has to be, so such things that we educated to the startup, and the fact that look, investor ko bolna padega ki look, this is like swimming not in a swimming tank, swimming in the ocean. Wo fun bhi hai, kick bhi hai, all of that, right? But swimming in the ocean, right? So you can drown, you can get eaten by a shark or whatever it is, but the fun is at a different level. So you choose or stay in the tank, right? But don't say ki I want to swim in the ocean. And of course, there are some safety nets. Like you can be. So we will check as a CA that are you equipped to swim in the ocean and so on and so forth. That's where I said that is the investor qualified enough? Does he understand the risks? Prepare him for that. And that is our role. And as you prepare, and in fact, you should take such session, just as a suggestion to the Kochi branch, see if you can put together your Chamber of Commerce, for example. Those are the industrialists who can possibly become angel investors. You can probably take a joint session there. Your association, jewelers, fisheries or Chamber of Commerce, they probably can come together because those industrialists who have made money may want to diversify, right? A fisheries guy might want to put money in some other kind of startup. So that's where you will find your angels.
Chairman, over to you.
Amazing session, Vinit Deo sir. I think it is probably first of its kind for our members and for us at the Ernakulam branch that it was an all out into the startup world on the perspective from the startups, perspective of the investors, perspective from chartered accountants and auditors who probably could be connecting investors to startups. All of it, we had a fantastic and a great view of the entire gamut of startup funding and it's allied features, whatever it falls. So we'll be grateful if you could also share your your PPT so that we could also upload it in our website. In between, have you received a question? Sanjeev Voraji would like to ask, our role would be like of a middleman or brokers. So
no. So I just saw that question. If the role is much bigger actually. So what a middleman or broker does is, let's say in real estate, or he'll say, "Ye property hai, or 50 lakh ka property hai, and lena hai to le lo." End of the story. You check, whatever. That's not the thing. I'll take the same example forward. That property wala thing. When an investor comes to you, you have to look at his risk appetite. I suppose he's got 5 crore rupees. Okay. Now, which property? Commercial or residential? Okay. Waterfront, villa, or there or in interior. So it starts from that analysis. Okay. Then what are the property rates in the area? Are they appreciating? What is the quality? When it will get completed? What is the ROI? And all of those things have to be looked at. So I would say that the middleman part is also there. Okay. But that is the last part. Preparing, presenting, analyzing, all of that will come into the play first. And then you will pitch to somebody, right? So you should probably, एक तो role भी है और वहाँ पे fees भी होना चाहिए. Otherwise, why would you spend your time? So preparing is one part and presenting is another part. And it might so happen that because you may not have contacts, and instantly, since you asked, we get references, for example, from chartered accountants who have got clients. So they do the role of, sometimes do the work of preparation. And because we know the VCs, we add on to that our knowledge here, and then we pitch. So that also happens. So, you can decide what role you want to play. Okay, so the fees, Mr. Vora, I think, wants to start practice from tomorrow itself. That's good to know. I think I'm happy that somebody is taking this. And I think one is really happy when the idea is to convert, because these are not education sessions. These are, as it said, professional. So people should start something out of it. That's the whole idea. So typically fees vary from city to city. The benchmark is two parts. You should ideally get a success fee of anywhere between 2% to 5%. Okay, you might feel of the funds raised, typically when the funds are raised, and a preparation fee of anywhere between 25,000 rupees to 2 lakh rupees, depending on what you do. Okay, scope. So for example, somebody may have a presentation, you are just revamping the presentation, adding some slides and so on, you might get 25,000 rupees and a plan. If you have to make the full presentation, projections, 5 years, etc., it might be 50K or 75K, complexity might be there and so on. So, but typically on an average, a 50K to 75K fee for preparation at a median should be charged, spread over a 2-3 month period, if not a lakh of rupees. And second, if it's a, let's say, just a 2 crore fundraise, then you might end up charging even 3-4%. 5 sometimes becomes too much because people may not pay. But somewhere between 3 and 4% is something which is possible. And if it's a larger deal, more than 5 crore, 10 crore, it might end up being a couple of percent.
I'm sure if we wait around, we'll get a lot more questions.
No. So that's why my WhatsApp, anyway, I'll share these presentations with you, Ranjit, and my email ID, and this is where happy to answer. In fact, all of these presentations have come out from such seminars and EA only. But as we get questions, we refine it.
Thank you, sir. I think your answering all these questions also helped a lot, bring a lot of clarity. A lot of these were questions all of us wanted to ask, especially the one on the fees.
Yeah.
I'm glad someone asked it.
Increase your EA substantially. I would recommend next decade is going to be a decade of start on many things. And in fact, just as the last year, as a branch and wherever I take sessions, this is the advice I give. Please identify sectors, because you guys are in the chair right now. So let's say electric mobility is going to be a big segment. Green, if you see Reliance, Adani, everybody is investing in green power and so on and so forth. Now, what happens is many of these industries themselves, our members are not aware of. And a lot of these opportunities are going to come up in those industries, right? So we may not as most of us are small practitioners, but even if you get a part of the business or you don't know where to look for, right? So green energy or electric vehicles and electric vehicle manufacturers, for example. So you may not get a vehicle manufacturer who's 1,000 crore, but somebody who makes components for it can be your client, and so on. So I think such brainstorming can be on the potential next decade wala industries. Healthcare today is in fact on front page of all Ayushman Bharat ka has been announced. So health in India used. Health centers and so on and so forth. You will see a lot of action happening in that space. Infra setup, laboratories, hospitals, and so on and so forth. Post-COVID especially.
All right, so I think that's it from us.
Okay.
Thank you once again.
Thank you so much. I thank you so much for the invitation. It was a real pleasure to be there. And as I said, a fond memory. We had visited the whole Kerala, Kochi, Munnar, everywhere. I mean, post-marriage, I was there, and even 2 years back, just pre-COVID, that was our vacation. So Kerala, I was there with that boat and so on.
So I think hopefully we'll have a residential seminar in Kerala sometime soon. So you can
that's what I was hinting at, with very selfish motives.
All right, so thank you very much.
Pleasure being here. Yeah.
Thank you, sir. Thank you.
Yeah, thank you. Yeah.
All the participants, thank you once again. We hope to see you tomorrow. Thank you. Good night.
Thank you. Thank you so much. Thank you.